Hey there, you've probably heard about stocks, the stock market, or shares before. But what do they actually mean, and how do they work? A stock represents ownership in a company. When you buy a stock, you're buying a small piece of that business. Think of it this way. If you owned 50% of YouTube's stock, you would own half of YouTube. A share is simply one unit of that ownership. For example, if a company is divided into 10 total shares and you own 5 of them, you control 50% of the company. A stock exchange is the marketplace where these shares are bought and sold. Well-known examples include the New York Stock Exchange, also known as the NYSE, and the NASDAQ. But why do companies sell stocks in the first place? They do it to raise money, whether that's to grow their business, expand operations, or fund new projects. When you buy a share, you become a shareholder, meaning you own a portion of the company and have a claim on what it owns and earns. So how does this work in real life? Let's look at a simple example. Meet Sarah. She loves pizza and dreams of opening her own restaurant called Sarah's Pizzeria. After doing the math, she realizes she needs $100,000 to get the business off the ground, but she only has $50,000 saved. Sarah has a few options. She could borrow money from a bank, or she could bring in investors. She decides to raise money by selling ownership in her pizzeria. She splits the business into 10 equal pieces, called shares, and offers them to investors. Since the total value is $100,000 and Sarah already owns $50,000 worth, she keeps 5 shares for herself. The remaining 5 shares represent the other half of the business, so each share is priced at $10,000. Now meet Alex. He's a big pizza fan and hears about Sarah's plan. He likes the idea and decides to invest. Alex buys 1 share for $10,000. By doing that, he becomes a shareholder in Sarah's Pizzeria, owning 10% of the business and earning a share of its future profits. After selling the remaining shares to 4 more investors, Sarah raises the full $100,000 and opens her restaurant. Fast forward 5 years. Sarah's Pizzeria is doing great. It has opened 3 additional locations, and the total value of the business has grown to $300,000. Alex still owns 10%, but now his share is worth $30,000 instead of the original $10,000. If he decides to sell his stake, he makes a $20,000 profit. Of course, things don't always go up. If the restaurant struggles, loses customers, or can't compete, its value might drop from $100,000 to $80,000. In that case, Alex's 10% share would fall in value from $10,000 to $8,000, meaning he would lose $2,000. Over time, Sarah's Pizzeria could grow into a large national or even international chain, similar to Domino's Pizza or Pizza Hut. If that happens, Sarah might choose to list the company on a stock exchange like the NYSE or NASDAQ, allowing the public to buy and sell shares of the business. So why do people invest in stocks? Because they believe the company will grow, making their shares more valuable over time. They can then sell those shares at a higher price and earn a profit. Some companies also share part of their earnings with shareholders. This payout is called a dividend. But there's always a downside. Stock prices move up and down, and companies don't always perform as expected. When that happens, the value of your shares can fall, and you may lose money. Investing in stocks is a bit like riding a roller coaster. If you're interested in getting started, it's important to learn as much as you can first. A good approach is to begin with companies you understand and trust, and never put all your money into a single stock. Spread your investments across different companies. You can buy stocks for short-term trading or long-term investing, and I'll explain the difference in the next video. If you'd like more videos breaking down topics like this, don't forget to like and subscribe. Thanks for watching.